All right, Chapter 8, Internal Controls and Cash. And we have referenced this a little bit in the last two chapters about kind of protecting our assets. And that's really what internal controls are about. We need to have procedures in place that safeguard our assets. And our biggest assets here are going to be cash and our merchandise inventory if we are a merchandiser. And so we need to protect those. We need to protect them from theft, from accidental loss, from misuse. And if we can't do that, we really can't function as a company, because if we can't if we can't control our biggest assets, we're not going to be around any longer. Internal control is also designed to encourage, that's a nice way to say it, employees to follow company policies. It makes us more efficient. The more control over we have of these things, the less loss we have, the more profitable we're going to be, and the more control we have over the procedures, the more efficient we're going to be, and also to make sure we have accurate and reliable accounting records. Even if you're following GAAP and you are in compliance with the law, let's say, information needs to be accurate and reliable above and beyond that for internal decision making. So it's not just a matter of following GAAP, it's having the best information possible and the most accurate information so that you can make the best decisions. The primary law regarding this is called Sarbanes-Oxley, and this came about as a result of the Enron scandals and other stock-related scandals where all kinds of creative accounting was going on inside the company, and the stock prices were very misleading, and then when they got caught, the stock prices dropped and everybody's stock plummeted and people lost a ton of money. The Sarbanes-Oxley really is all about these internal controls, and it requires a company, a publicly traded company, if you're out there selling stock, to have internal control procedures. Not just have them, but report on the results of those. And so not just to have these policies in place, but I also have to prove that I'm going back and checking to make sure the policies are being followed, and that I have to post the results of those as well. And part of that, it requires them to have both internal and external auditors. Now, that said, Sarbanes-Oxley and some other laws and your procedures can cover as many situations as you can think of, but you really can't prevent all fraud. And the toughest one is when there is collusion among employees. And so we'll talk about different types of things that will help minimize the chance of fraud. And one of those things is to have multiple people involved in the process. But if they're all colluding together, then fraud can still happen. But it does make it a lot tougher. The other thing to keep in mind here is the cost versus the benefit of any procedure. There was an example, several years ago, and bank robberies in New Jersey were on the rise. And so this bank hired a consultant to say, what could I do to prevent these bank robberies? And so they came up with this plan, and then this, bulletproof glass and all this kind of stuff, and the bank didn't do it because the cost of installing this was so much higher than the current losses that they were experiencing through the bank robbery. So you wouldn't spend $6 million to prevent, a $100,000 loss. It wouldn't make any sense. It would cost you more than it would save you. And so that's something to consider too when we get to a lot of different things. The return policy that a store has, like a retail store, they have these in place to prevent loss, to prevent people from stealing stuff and then coming back and pretending like they bought it and returning it and making cash on this. And so that's why they have these policies. But sometimes if you make it too tight, yeah, you're going to prevent loss, but you could also prevent sales. People are like, oh, I never shop there because it's such a pain to return it. And so, you have to kind of, with a lot of these things, you have to look at, some of these could affect revenue. I was at a store once, and there had to be at least 6 or 7 employees working, but only one of them was on the register, and there was this big long line. And so the customers are sitting there standing in this long line, and they see all these people just standing around, all these employees just standing around. Well, the policy of only one person being on the register was so that, if the drawer comes up short, you know who it was, and you don't want more than one person in the register. And probably a lot of you have worked retail and you have something similar to that. But yeah, you could prevent that kind of thing, or you have a tighter control over the cash, but you could be losing revenue if people don't like to be standing in line for 20 minutes while they see all these employees just standing around not doing anything. So you have to really look at the full thing here and not just focus on preventing loss at all costs. The components of internal control, you have to have your procedures in place. Risk assessment, we look at the likelihood of something going wrong and then the potential cost if it does go wrong. And so there are some things that are likely to happen, but the cost is so small, or there are other things that the loss would be bigger, but it's so unlikely that would happen. And so that's how you kind of balance what you're going to do. Have an information system in place. Monitor the controls. So again, it's not just having the procedures in place, but monitoring those. And then creating an environment that employees know that these internal control procedures are very important, that management sets that tone, and it carries all the way through. And so employees, if they see their assistant manager stealing money, that sets the tone that this is okay in this environment. So the really top down, that environment is set from the top down, and that doesn't again mean you can prevent all of it, but it does say that, hey, this is not acceptable here. And then these controls are monitored by both internal and external auditors if you're, again, a bigger publicly traded company. So some types of procedures: having competent, reliable, and ethical personnel. You don't really know when you hire somebody if they're ethical or not. You can ask questions in an interview, but they're going to tell you what they know they want to hear because it's a job interview. But do the best you can. If they demonstrate unethical practices and they're still here, that again sends a message to other people that this is okay. So you have to watch that. But competent and reliable, that sometimes comes down to training. Are they trained to do this? Are they, maybe some of the mistakes they're making aren't on purpose, it's just they've never been trained. So part of that is your responsibility to make sure that they receive the proper training. Assigning responsibilities, making sure that everybody's clear whose job is what. Separation of duties. We're going to talk about that when we get to cash a little bit here, cash receipts and cash payments. But if you have more than one person responsible for different parts of the process, that eliminates a lot of the potential for fraud. Having those audits, having documents. When we get to cash payments, we'll say, so you got 3 different things here in the cash payments. Different people, this person can approve the check, but this person over here signs the check. So we've separated the duties and it's clear who's responsible for what. But then we have documents to go with it through most of what we do here. Somebody's not going to approve the check unless I have a purchase invoice, a receiving report, and an invoice, so I can show that this is what I ordered, this is what I received, and this is what I got billed for. E-commerce, if you maintain if you're doing any kind of online business, make sure that you keep it safe for your customers. That sounds, like you shouldn't even have to say that, but you really do. And if you're maintaining any kind of information, if you store any information on your customers, you better make sure that it is secure. Other things, just having an alarm system on your stockroom, having vaults for cash and important documents that would be safe from a fire, because it's not all fraud. Some of this is just accidents. Job rotation. If somebody is suddenly out for unexpectedly, is somebody else trained to come in and do that job? Or the other thing is, when you rotate jobs, there's less of a chance that somebody's doing something funky because they know somebody else is going to come in there and see that. Some places have mandatory vacation because if somebody never, ever wants to use their vacation time, that could be a sign that it's because they're doing something they don't want somebody else to see, because if they go on a vacation, somebody else is going to have to step in and do that job. So if you have something and there's one person that does it, he's the only person that's ever done it, and nobody else touches it, that does open up your your chance for fraud. So rotating people through jobs can help. Okay, internal controls, cash receipt. So this is money coming in, right? I'm mainly talking here about a merchandiser or a service business. Manufacturers don't have a lot of cash coming into to the store, but they can have the second one that we'll talk about here. So there's really, two sources of cash. We've got in-store cash sales. And this is what I mean for a merchandiser or a service. A manufacturer's not gonna have that. But in-store cash sales, your cash register is your control device, right? Because at the end of the day, you can physically count how much cash you have, and then the register tells you how much cash you're supposed to have. And so there you can compare it. Here's what it says I should have. Here's what I actually have. If I'm off, then that brings up other issues. And most of you have probably worked somewhere where you have worked a cash register, and so you know how that goes. And generally, a manager comes and counts it at the end of your shift, or you count it in front of the manager, or something like that, so that two people have seen this and verified this, and that prevents people from just taking money out of the register. And then the other thing is, if somebody's short or over all the time, meaning they're not giving the right change back, it doesn't mean, if somebody's 5 cents off, they pulled out a nickel instead of a dime, whatever, that's not a big deal. But if somebody's continually off, then maybe they need to be trained better. Maybe that's what it is. And so it's not always fraud, but if you don't monitor this, you'll never know that that's happening. The second source is money coming in through the mail, and these are basically checks received in the mail. And so this could be manufacturers too. They could do this when somebody's paying on their accounts and their accounts receivable, that kind of stuff. And the important thing here is separation of duties, and we'll show you. Let me show you that over here. So this would be if you had a really tight process here. The money comes into the mailroom. The check comes into the mailroom. But because we assign the duties, assigned responsibilities in there, this person in the mailroom cannot endorse that check. So the check goes to the treasurer, who would endorse it and deposit it at the bank. But that's not the same person. Then that goes back to the controller, who actually posts it. So this is the actual journal entry there to post it to the ledger. And so then after it gets posted, the accounting department, the remittance advice, part of that is that it sends a receipt to the person, says, yes, we received it and we've credited your account. But it's also the one that matches up that the deposit ticket matches essentially the journal entry. So now I've got 1, 2, 3, 4 different people touching this. So if it was all one person, they could deposit that check themselves and check it off of somebody's account and pretend like it got posted and pocket the money themselves, right? But now, unless you had this collusion where everybody here is in on it together, then there's really not much chance of fraud on this one. So that's why having the responsibility separated and having it clear, because this person does the journal entry, but they're not authorized to deposit the check. So if we separate that out, we minimize the chance for any kind of fraud in there. Then there's cash payments. This is the money going out, right? So this is me making some sort of payment by check. Oops. And so the check itself is the control device. It serves a number of purposes. Number one, it is a record of payment. So if somebody says, oh, you didn't pay me. I can see that the check was cleared on this date. I can see what I wrote it for, and I can see when it was deposited into your account. So there's a record right there of any kind of payment. The check will have a required signature. Only certain people are authorized to sign the check, and the bank knows who that is. And so if somebody else tries to write a check who's not one of these authorized people, then the bank would, assuming they actually look at that, the bank would say, oh, nope, this person's not authorized to write a check for this business. And so so that means not just anybody has access, even if they actually got a hold of the physical checks, that they cannot still not write a check. And then the other thing is, again, if your procedures are in place correctly, no check's going to be written without the backup documents to go with it. And that's what I want to show you here on the next one, and this is out of the book. So when I order inventory, first here I have the purchase order, and then the inventory comes in, and it'll come in with an invoice and a receiving report. And so this is what I'm billed for, this is what I received, and this is what I ordered. And so if one person did this start to finish, they could pretend, they could be working out a deal with their friend, they could pretending like they received stuff that they never received, and then paying this person and splitting the difference. But this way, this check right here is not going to get written until somebody verifies that what I ordered is what I received, is what I was billed for, and then that check will go through. So we have these three documents, and we should have different people. The person doing the purchasing is person A, the person doing the receiving over here is person B, and the person writing the check is person C. So we really should again have those all separated so that that minimizes the chance that anything funky could be happening there. It doesn't again completely eliminate it, but it does make it much harder for something like that to happen. So petty cash, let's talk about petty cash. Most businesses will have a small amount set aside for day-to-day transactions, so that I don't want to, so let's say we go here. All this stuff has to happen before somebody can write a check. Well, if I just need to run down to the store and get some Band-Aids to have in the office, I don't want to have to go through all of this stuff. It would be kind of cumbersome. Or the Girl Scouts come to the door and want to sell me some cookies, and I say, well, I'm going to have to have a purchase order and a receiving report and an invoice before I can write a check for this. So that's not really feasible. So for things where that's not really necessary, generally small amounts, we have a petty cash fund. And most businesses will say, okay, if it's under $20, it can go through petty cash. If it's over $20, it has to follow the regular procedure with all the other stuff to go with it. So petty cash is an asset. Okay? It's kind of like a subset of your cash. The petty cash fund should have a custodian. This is a person who is responsible for the petty cash, for dispersing the money and writing the receipts of it. So if you had a really small office, you could probably have it where anybody could get to the petty cash. But most places have one person. It's often like the administrative assistant or the front desk person who is responsible for that. It'll have a designated amount. So we'll set a petty cash fund of $100 or $500 or whatever it is. And then generally there's a limit too on what can come out of petty cash. If it's more than $50, it can't go through petty cash. And then for all of the cash that comes out, there should be a receipt or a petty cash ticket. And so so I go to my office associate or my administrative assistant and say, oh, I need $12 petty cash to pay this delivery person or something like that. Or I need to go to the store and get some colored paper because we're out. So she gives me the cash, and then a receipt or a ticket goes into the petty cash drawer. And so the total of the cash in the drawer and the receipt should always equal this designated amount right here. So to set up the petty cash fund, let's say I'm going to start, this is the first time, I'm going to set up a petty cash fund of $200, okay? So the journal entry to do that, again, petty cash is an asset, so I debit petty cash, $200, and then I credit cash, $200. I'm moving it from one type of cash account to another type. So cash is generally going to be like your checking account, so I'm essentially moving it out of the checking account and into this petty cash fund. And that is really, unless you decide to change the amount of your petty cash fund, that is the only time you actually touch the account petty cash, okay? So this is the setting up. Replenishing the petty cash fund. So probably once a month or so, you go in and you say, okay, well, we've used some of that $200 we put in, and I need to replenish it, which means I need to bring it back up to $200. And so to do that, let's say your petty cash fund was established at $200, okay? So now it's the end of the month. Let's say I do this once a month. And I look, and the cash in the drawer, I'm pretending like it's a drawer, equals $118, all right? So right now, and then they'll say, and then the tickets add up to blah, blah, blah. So the fund is $200, and the cash on hand is $118. So right now, regardless of what my tickets add up to, $82 is the amount that I need to replenish. I always figure that out first before I look at the other stuff, and I'll show you why in a minute. So I have a bunch of tickets, and they all add up to $80. Okay, and so the total accounted for, the cash plus the tickets, is $198, but the petty cash fund is $200, and so that means I am short $2. Okay. Let's say these tickets right here added up to, I had office supplies, I had to run out and get some more colored paper, whatever, $60, and there could have been a couple of those, and a delivery expense was $20. So there's two tickets in my drawer, one for $60 and one for $20. So $2, I don't know, went missing. Somebody was in a hurry, they grabbed $2 out to tip the pizza delivery guy, and they forgot to write a receipt or something like that, okay? So I'm short $2. If I just added up my tickets, I would come up with $198, but I need to put $82 back in there because my goal in replenishing the petty cash fund is to get it back up to this $200. So here's what I need to replenish. Here's what my tickets add up to, $82 and $80, which means I'm short $2. The other way to do it is the cash in drawer plus the tickets is the total accounted for. And then that's different than my fund by $2, so that's the amount that I'm short. So let me show you what the journal entry looks like for that one. So for these things, the money that came out for real things, real expenses here. And so I need to record those expenses because these are things that really happened, right? Really bought office supplies, I really paid a delivery expense, so I need to make sure I record those transactions. So I will debit office supplies, for $60. I will debit delivery expense for $20. I know that the cash I have to put in, so it's a credit to cash for $82. That's what I need to replenish. $82. And so that means I need $2 over here, and that goes to an account called cash short and over. You would use the same thing if you're running a retail store and somebody's somebody's drawer comes up $2 short, it goes to cash short or over. If you're short, it's a debit. If you're over, it's a credit, but you use the same account to track that. And so but keep in mind here that this credit goes to cash, not petty cash, because I'm going to take $82 out of my checking account and put it back in this petty cash fund in this physical drawer, so that it's back up to $200 to start the next month. So that's why it's coming out of cash, not petty cash. And so that's why I always figure out this first, and then I record my actual expenses, and the difference goes to cash short and over. So here's one where we can do that one. The first thing we want to do is establish a petty cash fund of $200. And so we debit petty cash on March 1st, and we credit cash for $200. Then at the end of the month, I'm going to replenish the petty cash fund. It has $19 in cash. So it has $200 is the petty cash fund, $19 is the cash on hand. So $181 is the amount of cash I'm going to have to put back in the drawer, okay? So we have $188 in tickets, so I can see that's not going to match. I'm actually going to be over on this one. But here's what they were used to pay for. So I'm going to debit office supplies for $68. That takes care of that one. I'm going to debit entertainment expense for $120, and then I know my credit to cash is going to have to be this $181 right here. And so now I can see that this adds up to $188, and this is $181, so I need $7 over here on the credit side. So that'll be a credit to cash, short, and over. Maybe somebody meant to take out $120 and they actually didn't take out quite enough or something, or somebody put it back from the month before or something like that, because whatever. So, but I'm over by $7, so that goes here. Some months to be over, some months you're, again, generally people are kind of rushing through here, so that's not really that unusual. Then on April 15th, I decided that I'm cutting it too close, bringing it all the way down to 19, so I want to increase the balance of the petty cash fund to $250. So I want to bring it up to $250. It's already at $200, so that means I want to increase it by $50. So the journal entry to do this is a debit to petty cash and a credit to cash, just like when I'm creating it for the amount of the increase. If I did this for $250 and it already had $200, that would bring it up to $450, and that's not what I want to do. So I'm going to just make my adjustment here for the difference, and that will be the $50. So I think I'm going to pause this here and then come back and do the bank reconciliations and the bank account as a second video. And so I'll be right back.